For those interested, a Polish Monetary Policy Committee member, Kotecki, says Poland.
This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 5th and some highlights from today's show. Germany opens the fiscal taps, the Eurodollar bears are now trampled, and the DAX is a win-win trade. Good day traders, and welcome to another daily market rundown. Let's get stuck straight into it. Quite a number of things happening in the overnight session. Of course, we had quite a bit of news flow again late yesterday, starting off, of course, with Trump giving his 90-minute sort of speech in front of Congress. Again, he didn't really reveal anything necessarily new. I don't think there was anything, sort of specific to take away from it. It was more of what we've heard previously. There was no sort of, shock in terms of, wow, he said something new. And of course, there was no minerals deal. What we do know on the Ukraine-Russia front is that Zelensky has sent a letter pretty much asking to re-begin discussions over the negotiation process. Now, aside from that, in terms of what the key takeaway was overnight, it's very much all got to do with Germany. We've been talking about this for quite some time now in the Daily Market Rundown, particularly as we headed into the German election and the results of the German election. Now, what's ultimately happened is we've gotten a bit more news and understanding as to what German politicians are thinking in terms of fiscal spending. And they did not disappoint. I think that's a key way to look at this. This has got all the potential to be a real game changer, not just for Germany, but for Europe in general. Now, a little bit of context what this has come off the back of. If you focus your minds back to last Friday, of course, that's when we had the sort of clown show in the White House where Zelensky was kicked out and told take the deal or otherwise. And as a result of that on the weekend, we just seem to have had almost a 360 turn from European leaders where they recognize now that perhaps America is not as much of an ally as they would like to have been. And as a result now, we do have a bit of urgency coming in terms of fiscal spending across Europe. Now, what that has resulted in is two things from the German CDU party and the proposal. What they've basically proposed is one, that the fiscal debt break ultimately gets relieved in terms of military spending. In other words, they can spend well beyond the 0.3% fiscal restraint on when it comes to military spending. And at the same time, they've proposed a 500 billion fund over the next 10 years to invest in infrastructure and investments into the economy. Now, at face value, this is significant. It's a significant amount of flow coming into the economy, and it's obviously a leaf out of the US economy. If we look at what the Biden presidency did, they very much were spending 5-6% of debt to GDP on infrastructure spending, and the result was we had the US economy being the star economy, the only economy around the world that in fact was growing. So this is significant. Okay, fiscal spending of this magnitude is significant, particularly because of the context of Germany having been in a recession for already 2 years now. So I think that's the key takeaways. Now, there's a few little blockers here. There's a few things to be aware of as day traders, because I suspect this is not the end of it. This is not a guarantee that it will get through. We have got a very small time frame now in which the CDU does need to put this in front of the current Bundestag because they do wrap up effectively on the 23rd of this month. Okay, keep in mind we had an election, which means we now have got a new Bundestag forming on the 23rd. But before then, they can technically change the constitution. So time's of the essence. I think that's going to be key. And some of the blockers, I think the Greens are now the only real blocker to this initial sort of infrastructure spending bill. And again, I suspect what happens here is I suspect we get a little bit of pushback from them. I suspect we get a little bit of sort of, again, cards being traded here where they say, look, we want you to plant some more trees and in exchange we'll vote for you. Okay, so I think there's going to be a little bit of that. There's going to be a little bit of pushback. Why? Well, because the Greens want to make sure that they can say to their constituents that, look, we got you something. So do expect that. Do expect a little bit of pushback. But again, the key theme here, the key trend is for more spending. Okay, I think that is undeniable. We are going to get this through the Bundestag, and the markets now are already starting to price this eventuality. So I think that's the key takeaway. Watch for that little bit of news flow, but remember, just because the Greens are saying, look, we want a bit more, we want to extract some more, we're not going to vote for it in its current form, doesn't mean it's not going to get through. Okay, so it's very much going to be, of course, trade the news flow. There will be a little bit of reversal on a Greens pushback, but at the end of the day, it will just give you really good opportunities to be long DAX, be short bonds, and of course, be long the euro. Now, that in mind, let's talk, we'll get to the charts in a minute, but just briefly, I think this is also now crossing the markets. We've had Alarian come out, raising his odds of a recession. And again, this is something that was perhaps missed a little bit in Trump's Congress speech yesterday. He came out and he started by saying, look, guys, we have to accept a little bit of short-term pain. And I think that wasn't stressed enough. What he's telling us is, guess what? We are going to have quite a significant setback in growth in the near term. Okay, keep in mind, economists are forecasting US growth at 2.3% this year. I expect it could come somewhere in below single digits, so less than 1% effectively this year. So keep an eye on that. Those revisions are coming, and hence why the equity markets are staging a bit of a correction. Now, what the market's not pricing is a recession. Okay, the market's not pricing in zero growth or negative growth. It's pricing in low growth. Okay, so to get equities lower, to get these bonds moving even higher, we're going to need even worse data. We're going to need a real recession to really get the equities lower and get the bonds high. And I think that's important to understand. Whilst we, of course, want the markets to go down in a straight line, don't forget we have had quite a significant correction already over the course of the last 2 weeks. Now, let's turn our attention and get to some of the key charts, starting with the German bunds, and we can see that breakout now. I think German bunds are up 20 basis points on this fiscal spending plan. Again, what I will just stress is if you go look back at 2014, I think that's a really good way to understand how the bunds will move. What you'll see in 2014 is that's when obviously the ECB begun quantitative easing, and as a result of that, we saw effectively bond yields slowly trend down over a period of 12 to 18 months. Okay, now what I want to stress is I think this fiscal spending plan is identical to a form of a QE type plan, in that I think bonds will slowly move higher, okay, up and to the right. Today's move, of course, it's a little bit of a repricing event, but in the long run, yields are not going to just spike back up to 3%. Okay, I think we perhaps could get up to 3% at some point this year, but I suspect it's going to be a slow little move up towards that point. Okay, don't forget this infrastructure spending plan is 500 billion over 10 years. Okay, not 500 billion tomorrow. So don't forget that. I think that gets a little bit missed on the markets. Don't be surprised to see a lot more two-way trade in the bunds now. But the general trend, the general travel of direction is for a steeper 210s. Okay, we can see that. The curve's steepening quite nicely. And at the same time, I think those long-end yields are slowly going to drift back up towards that 3%. Okay. Now, one thing to pay attention to is that this is de facto tightening. This is not really what the ECB wants to be seeing at a time when they're cutting rates. So again, that could also likely open the door to perhaps a few more rate cuts from the ECB because they do now need to counter this the de facto tightening that's coming in via higher yield. So keep an eye on that as well. That will, of course, be a discussion at the ECB over the course of the next couple of days and weeks. Now, the key standout performer, and I think this is a key pairs play. Okay, very, very seldom will you hear me talk about pairs plays, but this is one of those pair plays that I think started at the start of this year. And we'll get on to rebasing in a minute. But this is the DAX, the German DAX. And we can see that since that election result, okay, the markets really have been getting ahead of this idea of a fiscal spending reform. Okay, it's been in the market for some time now. The news was announced, yeah. So yes, perhaps we get a little bit of, sort of buying the rumor, sell the fact type price action. Perhaps a little bit more sideways trade inside this 22,500 to 23,300 area. But in general, this is nothing other than just a big consolidation area ahead of a continued breakout. Okay, right now, to date, DAX is up, call it 12, 13 odd % on the year. And if we go and compare that to S&P, it's almost flat to marginally down on the year. Okay, so we can see a significant divergence open up between Germany and the US. Now, this is one pairs play I really, really like. Why? Because we've been talking about growth exceptionalism and United States exceptionalism for the last 2 years. It's become a little bit boring, actually. When in reality, now it's going to flip on its head. Okay, now we have the US economy contracting. We have fiscal spending contracting. Not yet, but that's the plan. We have a government that's hell-bent on reducing demand via tariffs. So as a result of that, what we should start to see is a little bit of flows move back into Europe out of the United States. Okay, which is why I've termed it as DAX is a bit of a win-win here. Okay, because I think DAX will act now as a star outperformer this year. I think it will be for the entire year, effectively this is one of the strongest equity indices around the globe. And so it will be a very good diversifier for not just European portfolio managers, but also US portfolio managers that are just looking to offset a little bit of this risk coming into the US economy. Okay. And there you can see it. In the blue, we have the S&P 500. In the pink, we have the DAX. Okay, and you can see ever since the start of this year, all right, you can see the DAX was up around 65% over the last 3 years, with the S&P up almost 100%. Okay, and you can see in just the last 2 months, that divergence is completely shut. Okay, I expect this to continue. More importantly, I expect this pink line to be above the blue line over the course of this year. In other words, continued outperformance by the DAX versus relative weakness in the US economy. So pay attention to that. It is a very good pairs trade. It's a pairs trade I think you can keep on for the next year. I think DAX is going to be a standout performer over the course of the next 18 months. Now, with that in mind, if DAX is going to outperform, if bond yields in Germany are going to rise, and in general in Europe, and the ECB perhaps is going to have to keep interest rates a little bit higher than everyone thought, well, guess what? That means that pretty much everyone who was short euro coming into this year now needs to stop out of those trades. Okay, like I said to you yesterday in the rundown, this was a key breakout of that 105.53. We did not get a disappointment there. 160 pips through. All the shorts are now stopping out of that play, and it was a parity play. Okay, if you go back to the daily market rundowns from last year, I was also calling for parity. Okay, and I pretty much expected we would get to parity. We almost got there start of the year, didn't quite get there, but everyone was short for the same play. Now, unfortunately, everyone wants the same play, which is everyone wants to be long the market. Okay, in terms of technical levels, well, guess what? There's a new fundamental in play here, and effectively we are back inside this 18-month range we've been in, like I said, or more than 18 months now. Since September 23, we've been inside this range. So for all intents and purposes, there is no resistance. We should come back up to this 108.50, get retested. Perhaps we then back off a little bit. But in terms of path of least resistance, 110 is coming into view, and I expect 112 is going to trade before the middle of the year. Keep a close eye on this. This is a market that very much is going to be a buy-only market for the foreseeable future. And we can see that as well by the interest rate pricing. We can see how the softness in the US is ultimately leading to more rate cuts being priced versus less rate cuts in Europe. So euro dollar is the star performer. Not only does the technicals point to higher prices, not only does fiscal spending point to higher prices, not only does US growth weakness point to higher pricing, the reality is euro dollar is moving back up higher, and it's going to be doing it in a relatively short space of time. Let's turn our attention, of course, to the S&P 500. Some wonderful technicals. The market here beat me to this slightly. Although he was preempting, it is a fantastic chart nonetheless. He's been banging on about this for a while as well. This is just a massive range. Okay, it's a massive range we've been in for the last 5 months, and we should never discount these ranges. Okay, I think the temptation is sometimes perhaps to think a market just moves down in a straight line, when in reality it doesn't. Okay, as day traders, we are conditioned to think it moves in a straight line, but it doesn't. Okay, so I expect today we are now back inside that range that we've been in for the last 5-6 months. What that means is I think we're probably going to get a little bit of consolidation play. Okay, like I said to you earlier on, to get the equities down now, to get the bond yields further down, you're probably going to need to see more pricing of a recession or more weak data. Okay, we haven't had any key economic data for some time now. Of course, we do get that on non-farm payrolls on Friday. But for today, yes, we do have the ISM data. And I think that's going to be important, because should that number come in line or just even a little bit better, okay, I think we are going to stage a little bit of a short squeeze. And I think we do have the potential to move our way back up towards that 59.60, which is a good 100-odd handles to the upside. Now, what to pay attention to in terms of the triggering of this? Well, I think yesterday's high is crucial in the S&P. We take that high out, and I think that is going to trigger up some short squeeze. At the same time, watch the VIX. Okay, I think the VIX is going to stage a very similar play to what we had last week, Wednesday, where we had a relatively weak close in the VIX. We took out the previous day's low. I expect we're probably going to take out yesterday's low in the VIX, and that will coincide with that break to the upside above that yesterday's high. Should we get that, I do expect we are going to squeeze quite nicely in the US equities. But again, that doesn't change the trend. Okay, the fact that VIX is starting above 20 is that it means we are always wanting to be selling into rallies. Okay, until we get back below 20s, we do not want to flip our books. But like I said, given the technical structure, given, you know, bond yields as of now. I mean, we can see the bonds are offered today in the US, so very much it is a risk-on environment for the equities today, and given the positioning, I do expect we do have a very healthy bid up in the afternoon session. All right, let's then turn our attention and just talk a little bit about some of the economic data. Like I said, we do have ISM out today, and I think that's going to be very closely watched. It is the services one. It is the one that is showing quite a significant weakness. Should that come in weak, what does that do? Well, I think a weak number just adds sort of fuel to this idea of you know, weaker numbers. But I'd watch it very closely, particularly in the bonds. Okay, I think if it gets faded in the bonds, that just confirms as well that equity buy trade opportunity. And so I'm very much of the belief that unless we get a shocker ISM today, I really do think the equities will stage a bit. And of course, like I said, the euro should continue its ascendancy back up towards that 108.50 in the near term. All right, if there are any other questions, of course, the Discord channel is there for you. Otherwise, as always, manage that risk. Good luck out there. Go make some money.